United Health stock was down over 7% today after the DOJ announced that they're going to be investigating the company over their Medicare billing practices. United Health is the biggest health insurance company in the entire world, taking up 15% of the entire market share. So after this sell-off, I decided to see if we should buy United Health stock and see if this is a good value to buy the stock. Using my 7-step stock analysis, I'm going to be determining the overall health of the company financially, and then at the end of the video, I'm going to be using an intrinsic value calculator to determine what price we should buy United Health at. The first metric that I'm going to be looking at for United Health is the PE ratio. I want the PE ratio to be greater than 0, meaning the company is profitable. The PE ratio is the price of the stock divided by the earnings per share. So this is a valuation method to see how much you are paying for $1 of earnings for the company. So as we can see here, the trailing PE ratio of United Health is 32.39, which is greater than 0 and means that United Health is profitable. So that is a check mark. Now I'm going to look at the forward PE ratio. I want the forward PE ratio to be less than 30. Basically the same thing as the PE ratio. Instead of the normal earnings per share right now, this is the earnings per share expected by analysts in the future. I want this less than 30 because that means the company is probably undervalued. As we can see here, the forward PE ratio for United Health is 16.89, and that's pretty low for a good company like United Health, so that's also another check mark. Now I'm going to be looking at the revenue growth of United Health, and I want this to be greater than 5%. Showing that the sales of the company over the past 10 years have been growing. And as we can see in this chart, every single quarter has been increase in revenue. So this is very good, and it's been increasing at an about 10% rate. So this is double of what we want. So this is insanely good growth and just very steady increase in growth, and I really like that for a company. We want a company's revenue growth to be very predictable, and this looks very predictable at a decent rate. Next, I'm going to look at the earnings per share growth of United Health. Similar to the revenue growth, I want this to be growing at a 5% rate or greater. As we can see here, it has been increasing very nicely until 2024. It had a pretty big decrease from 23.86 earnings per share all the way down to basically 15. So that doesn't look very good. However, over time, I do think this is a check mark and growing at a good rate. If they can start to increase this again, I think this is pretty good. But it is a little worrisome that this did just fall a lot during 2024. But nonetheless, it's still a check mark for the earnings per share of United Health. Next, I'm going to look at the shares outstanding for United Health. I want the shares outstanding to be decreasing over time and them buying back their shares. The reason I want them to be buying back their shares is because if they do buy back shares and the shares decrease over time, that means one share will be worth more. And as we can see in this chart, over time, United Health has been buying back shares pretty consistently, besides in 2017 and 2018. However, over time, it has been decreasing at a decent rate, at about a 1 to 2% rate. So this is pretty good for United Health and means that us shareholders are not getting diluted. So that is a check mark. The next metric that we're going to look at is the total debt divided by equity ratio. I want this to be less than 100% because if it is less than 100%, that means they have more equity than debt. And as we can see here, United Health has a 74.96% total debt to equity ratio, which is less than 100%. However, it is pretty high, but it's still less than the 100% and means that they have more equity than debt. So that is a check mark. Finally, I'm going to look at the earnings per share estimates over the next 5 years by analysts. I want this to also be greater than 5%, similar to the revenue growth and the trailing EPS growth. And as we can see here, analysts expect United Health to grow at about a 12.4% rate over the next 5 years. So that is a check mark there, and it shows pretty good growth for United Health. The final thing that I'm going to do with United Health stock is use an intrinsic value calculator to determine what price we should pay for United Health stock. In order to get a fair value price for United Health stock, I have to use assumptions for the next 10 years that I think will happen. First, I have to assume what the revenue growth rate will be for United Health over the next 10 years. I'm going to put this at a 10% rate. As analysts expected, their earnings per share is supposed to grow at about a 12% rate. So I'm going to put this at about a 10% rate because I think Over the past 10 years, it's been 12%, but over the past 1 year, it was 9%, so I'm going to go about in the middle here. So I'm going to put this at 10%. Then the net profit margin, I'm going to put this at 5%. As we can see with the other net profit margins, it's been at about a 5 to 6% rate, so I think a 5% net profit margin seems pretty reasonable. Finally, for the terminal PE ratio, I'm going to leave this at 20. Because the revenue growth rate isn't crazy high and the S&P 500 average PE ratio is about 20, I think we can leave this at 20. Also because of the huge competition in the insurance business and also because of the regulations of the United Health company. Finally, the discount rate, I'm going to leave this at 12%. And as we can see here, I think United Health's fair value is $554.91. So if you bought this today, believing these assumptions I have here, you'd make about a 14.4% year-over-year return on your investment if you bought today. So thank you guys for watching this video. Please subscribe, hit the like button, comment down below what stocks you want me to look at next. See ya.